Welcome back to another episode of Fun Friday with prolific and legendary investor Jeremy Roll. How are you today?
Doing well. Thank you for having me on. I appreciate it. How you doing?
I'm doing great, thank you. Well, it's funny, Rob Beardsley and myself continue to talk about the conversation that we had back in BEC. I've been meaning to get you on the show, of course, naturally, but you're a busy man with moves, this and that. But I'm excited to have you here today to talk about some of the market fundamentals, economics, and where the opportunities lie from investing. So, figure there's not a better person in the world to be speaking on the subject than you here personally, with your acumen from Wharton to this to that. So, without further ado, would love to get into it. Yeah, so tell me, what are you seeing in the marketplace right now? Because it's certainly an exciting time.
Okay, so before we start, I just want to say I'm not a financial advisor or investment advisor, accountant, attorney, anything like that. So anything I'm sharing today is just my perspective as an investor, may or may not be right. So that's very important. So I'm going to answer your question in kind of with two buckets in terms of what's going on right now. Well, first of all, before I even get to that, it's kind of important to understand that we just had a very interesting past few days in the stock market. We're currently recording this in early August, and late last week and early this week, we had a whole thing with Japan carry trade, a little bit of recession fears, and the stock market took a pretty big dive for a couple of days, and now it's kind of stabilizing, it seems. So it's very interesting times right now. What I'll say is that, I'm going to answer the question in two ways. One is an economic perspective, the economy, and then the other is the real estate market, right, in terms of what I typically invest in. So on the economic side, and I've been saying this for a very long time, I think that the inverted yield curve and many other data points and metrics are telling us that we have a very high probability of a recession. Obviously, it's possible we have a soft landing. I think that's highly improbable. I've said that for the whole time, that just based on the data. And unfortunately, because we've now had a record long inverted yield curve over the past roughly 100 years, what that tells us is, unfortunately, there's a proportional relationship between how long the yield curve is inverted and how bad the stock market decline typically is and how bad the recession may be. And so, if you actually look at the historical charts and kind of extrapolate right now, you would expect, and I know this is very hard to picture, I can't even picture it really, but you'd expect about a 45 to 50% stock market decline from peak. And if that were to happen, then you would have obviously a huge change in liquidity, both on the investor side of equity and also on the lending side of debt in the real estate space. And that will definitely fundamentally change a lot of things, including pricing, most likely. And so I am actually expecting that to happen only because it's my base case, because that's what the charts say, at least what I can tell. And so I am personally on the sidelines kind of waiting to see what happens with the economy, with the potential recession. And another, interesting note for people, food for thought. A lot of people don't know this, but the most common scenario when the Fed starts to cut rates is that the stock market then goes down maybe 1 to 3 months later. Sometimes it's before and sometimes it's after, but it's very common that you're not peaking in the stock market until after the first rate cut. And the reason is because everyone kind of had a little bit euphoria, the rates are coming down, there's more liquidity, it's going to be easier money. But then all of a sudden they realize that as the data gets worse and worse, that the reason why the Fed cut rates is because we're going into a recession. And that's the most common scenario as well. So that's kind of what I'm anticipating. We obviously have an election year, which complicates things a little bit, but I don't think it's going to complicate things that significantly. So my base case at the moment is that we're likely going to have, or most probable case is we're likely going to have a recession sometime in the next 6 to 9 months. I think that'll become obvious as we continue going along in our next few months. On the real estate side, I just want to say, I invest like you guys in multifamily and some other asset classes as well. And we know mostly that's already played out, right? So we know that there was a huge increase in interest rates in 2022. That's had a major impact on real estate acquisitions, floating rate bridge loans, and all kinds of different things. And that's impacted pricing and cap rates. But the one thing that I still am adamant about, that I've been telling everybody, is that there are two dominoes to fall. The first was the increase in interest rates. The second is the entire other string of dominoes that we just discussed about the economy and a recession. And that still is, to me, the highest probability scenario. And I think that will have the second leg down on the real estate side, and we'll finally get the full reset from that second leg and not just this first leg that's already occurred. And hopefully that will create positive leverage, even in market rate deals, and reset us back to the proper risk premium that we would normally get as investors. Right. So we can obviously get into a lot of stuff from that, but that's my overall thoughts.
So let's start with Japan. So could you break down real quickly what happened in Japan that kind of caused that
Yeah,
stock market turbulence? And then also
yeah.
a lot of talk about hard and soft landing, and you seem to believe that a soft landing doesn't seem to be possible moving forward. So I guess let's go to the Japan topic and then soft and hard landing after and where you think it's going to fall.
Sure. So for Japan, so what happened in a nutshell, and I'm not an expert on this, but from what I can tell, what happened is that there was a huge $20 trillion global carry trade on the yen, and what that means is that because interest rates have been artificially low in Japan for decades, and that's a whole other topic as to why that was happening, but that was done on purpose by the government. People were able to go borrow money at almost zero rates in Japan, and then when invested in anything here, treasuries, they can buy calls on Microsoft or Nvidia. And what's worse is that often people were taking that money that was borrowed and then leveraging it here through margin, right, on their stock accounts. And so they were double margin or double leverage, basically. What happened is that happens to be that the Japanese government tried raising the interest rates there recently. And when you raise, so all these traders who are borrowing at zero, and then they're actually investing in US dollars, not in yen. And so what they're banking on is the yen stays flat or gets weaker. If the yen gets stronger, it goes against them, and they have to then buy more yen to actually pay that back. And it starts to like work against them. And so that's a problem. So when the government increased rates, the yen actually strengthened quite significantly very quickly. A lot of people had oh crap, this is actually a huge problem for me. And they went to liquidate here, which is what you saw the stock market sell-off was a liquidation of people getting to cash to pay back their loans in Japan because the loans were getting more expensive to pay back by the day. And that was not anticipated. So, and by the way, think about what I'm saying. The Japanese government increased interest rates, not decreased like every other major first world country is looking to do potentially, depending on their own recession situation. So it was definitely a bit of an unexpected event, caught a lot of people off guard, and it's a huge problem because people are getting margin calls once things start to go down. It's kind of like it kind of builds on itself. I'm forgetting the term, but it's kind of it goes on itself, builds on it, gets worse. Thank you. So that's what happened there. So interestingly enough, if you looked at the media and watched the media here, you heard a lot about people getting scared about recession stuff. And no, in fact, that's not what triggered this sell-off. It wasn't that all of a sudden people got scared. Yes, it was coincidentally the same timing as a bad jobs report, and that probably did scare the markets. But the huge reaction was due to this carry trade having to get closed out and some margin calls and stuff.
Fair enough. So then, speaking on the next topic, which is soft and hard landings, as you know, the Japan stuff, that's a little bit above my intellectual grade here. But for soft and hard landing, there's been obviously easing. There's been rate increases that have been going on now for basically 2+ years, I believe. So
yeah.
what is your opinion as to what will occur from the charts and data? You're very unemotional about this, which is probably the best person to kind of analyze this, is that you don't really have a dog in the fight here. You're just trying to, get it right, not, be right per se. But where do you think it's going to go? Hard, soft with what you're saying?
Yeah. So it's not impossible that it'll be a soft landing. It's highly improbable. If you look at past historical events, pretty much almost every single time we end up in this exact scenario with an inverted yield curve and all these other data points and all these challenges, unemployment rate going up. It signals that there's going to be a recession, which is the equivalent of a hard landing. How bad a recession it will be is tough to predict. I will tell you, often when you have a longer inverted yield curve, the recession is worse, but it doesn't tell us that for sure. But I would tell you that, like, my opinion about hard landing is that it's easily over 95% probability. And by the way, what you'll find fascinating is that if you listen to a lot of analysts or banks, they're in the middle of changing their recession probabilities. Like I think Goldman raised theirs from like 30 to 35%. You'll never, like if you look back in 2008 and look at the media, these people won't tell you there's a 50 or higher percent chance because it's not in their best interest. You're their client. They want your investor money. They're never going to put their leg out and say that there was more than a 50% chance of a recession and then be wrong. So when you get analysts getting up to 35 or 40, that's kind of like them saying 80 or 90 because they literally will never get it 50 plus.
Well, when you're in the business of collecting fees based upon assets under management, it wouldn't behoove you to basically tell your investors to pull out or to liquidate or have a call because you don't want to bank run, obviously, on your investments and become solvent.
Yeah. So there's a lot of reasons why, so to me, the fact they're getting that high is also a very important signal because we're getting about as high as you get. Those people are willing to admit a percentage they think really is. So I mean, almost every metric is telling me that a recession is in the cards and coming. It's just a question of when, and that's very difficult to predict.
Right. So with that said, what would you say determines and what would be a recession with a soft landing, and what does the alternative, a hard landing, look like, typically speaking, and then what the future scenario coming up here? Obviously, with, it hasn't happened yet, but can you paint a picture for just people to kind of plan accordingly if this
Yeah.
prophecy becomes true?
Yeah. So what you would expect from a hard landing or basically a recession is the following. You'd expect a stock market correction or crash. I would say that I'll be surprised if the correction is not at least 25 to 30%, because that would be, roughly average or even a little below average. But again, the inverted yield curve being for a record long for the past 100 years roughly is telling us that should be worse than normal, like just in terms of expectations. And then when you have that degree of a stock market correction, somewhere, say, call it between 25, 50%, you have fear. You have people having a much lower wealth effect and less spending. You have wealthy people who were previously investing in alternatives and other things tend to ratchet back and now be very careful with their capital, like, again, any other recession. And that impacts the ability for syndicators to raise capital on the equity side. At the same time, you have banks who are suffering, potential losses. Maybe they're not marked to market, but things are getting worse, and they may have money being pulled out of their banks into other things in the treasuries or whatever. So they can have a potential flight of capital. And long story short is that they start to shore up their lending because now they see the recession writing on the wall, and they have to be very careful with how they lend during a recession, right? We all know that it's much harder to get a loan in a recession than it was 4 years ago. So you'd expect that to happen both on the consumer side, but also on the syndicator side. It's the exact same thing. And so it'll be harder for a syndicator to get a loan. It'll be harder for a syndicator to raise capital because there'll be less people interested in investing. Ironically, of course, that means it's one of the best times to invest. But it will, when you have less demand on the buy side because of all these factors, and you have supply, then you have lower pricing, right? And also, when people are scared, they're going to demand more of a risk premium. They will be wanting to pay lower prices as a result. And that's what you typically have with a recession reset. Now, the other piece of that recession reset, though, is lower net operating incomes for properties. And why I say that is because I think you would agree, in most cases, you'd expect rents to either go flat or go down in a recession, vacancies to either go flat or go up. And also, in this current environment, you still expect expenses to go up. And so you have, if you own a building at the beginning of the year and there's a recession by the end of the year, your NOI is probably going to be lower, either because revenue is flat, expenses are lower, because revenue is low, expenses are higher, or revenue is lower and expenses are higher. Either way, your NOI is lower. And even at the same multiple, you would expect the building to be worth less. But when you have that compounded by lack of liquidity, fear, and lower prices, which is higher cap rates, then you actually have a compounded effect on the value of the building going down. So as an investor, I am on the sidelines waiting to see if that compounded effect is going to happen and whether there'll be good opportunities from there. And I don't think it's going to be very long until we find out.
Without a doubt. Well, that's all very interesting that you just laid out there. And Rob and I have talked about this before, where there could be a scenario. Now, it's not 100% likely. No one really knows. But we've talked about this before on our podcast, which is there could be an event in which NOI goes down, cash flow goes down, but cap rates remain the same, which is kind of an interesting topic right there, which, hey, it's
Yep.
really good value there, but cap rates haven't moved because there's enough people there, but there's just, rents are coming down, operating expenses are more expensive. Your margins are kind of shifting a bit.
Yeah. And that's what I was saying. But the problem is that if you have NOI down and cap rates flat, your value of your building is down. You're not getting the compounded effect, but the value of the building is still down. And that's one of my primary concerns, because I tend to invest in more stabilized cash flowing properties where there may or may not be any value at upside, and certainly not major value at upside. So I have to make sure I'm buying it at the right time and at the right price, because we're not creating a ton of value. And that's why I'm particularly careful at this timing of the cycle.
Yeah, well, actually, there's a couple points too that I actually really recall it stand out. So you've got a couple principles as it pertains to investing in multifamily, which is our expertise. So we'll just start there. So you've got the historical, we call it Jeremy Rollonomics, which is a 150-point basis spread of positive leverage, meaning your cap rate for a, let's say if debt is at 4.5%, you need to have a going in cap rate of 6%. So that was one of them. It's either that, or if I'm not mistaken, you just need to have basically a clear path of bottom. like, hey, you're okay not timing the bottom perfectly, but you want to basically invest when it's kind of flat or going up or slightly like that if you were to ever not take that, I guess, 150-point spread.
Okay, we need to just pause. Sorry, because you froze for like 10 seconds, so I didn't hear what you said.
Okay. Oh, yeah, I'll say it again. Yeah.
So I heard the 150 basis point spread, and when you said or,
Yeah.
you could
So,
just
yeah,
start from there again.
I'll just say, oh, yeah. So you need
Okay.
a 150 basis point spread, or you need to feel confident that the force is burned down, it is cleared out, and then there's a clear path of value creation, or at least a positive, uplift where the market's bottomed out and all it can go is up from there from a cycle perspective.
Yes. So you're 100% right. And I can't look, I don't put a hard line on 150 basis points because the truth is, if the market never gets there, I'll never end up investing, right? But what I look at is historically, I should be getting, in my opinion, is 125 to 150 basis point spread on maybe an A minus or B type of asset. And until I'm comfortable seeing that, what that tells me is that things are overpriced. And that is actually one of the indicators I use to know things are overpriced in the past few years, because every deal I was seeing was negative leverage, right? And that kind of tells you we're at maybe at the end of a cycle and it's just too expensive. So that's one of the very specific metrics I carefully follow. And if you were to say to me, when you're going to jump back in, what's the number one thing you could tell me that is going to tell you the coast is clear? That would be the number one metric. There's obviously others, but that would be the easiest metric for me to look at.
Right, is the positive leverage. Okay, and with that said, what have you been investing in basically from probably 2021 when, the market basically squeezed you out from not feeling comfortable? Where were you deploying capital? Because you can't just have money doing no return for you, right?
Yeah, that's a good question. So there were two things that I was really focused on during that time. First of all, I didn't invest in any of the floating rate bridge loan multifamily deals for multiple reasons, which we can get into if you want, but I didn't do any of those. So what I was focused on is, as it's the same thing I always focus on, which is longer term fixed rate loans, preferably 10 years. That hasn't changed. That has, whether it was last year or 2 years ago or 10 years ago. And because of my concern about negative leverage, anything that had positive leverage in some way was kind of unique. That was also a defensive play in anticipation of a recession, because everyone also needs to understand we've had a record long, economic boom here, and the recession is way overdue, right? So that's on top of everything else. So if you're in a record long recovery, that a recession is imminent at some point. So I was have to be defensive. So I was looking mostly at tax abated opportunities similar to what you guys are doing that created that positive leverage. And also, what a lot of people I think don't realize, the tax abated opportunities, in my opinion, are also a potential defensive play going into recession. Because just to say it, for example, if the half the units are income restricted, those units are technically going to be lower than market rents, especially over time. And then if there's a recession, you're already lower than everybody else's rents on the block if you're the only tax abated property, and you're probably going to have the most demand because you're the lowest price at that time, right? So that's obviously theoretical. It depends on the location, a lot of factors, but it's a nice defensive play going into recession on top of creating the positive leverage. So I was looking at those and invested in a whole bunch of those. I looked at some other stuff unrelated to real estate that I thought would do well, because I've been in historically like ATM machines that I know do well during a recession. I was in them back in 2008. And so, but otherwise, it's been very few and far between. Since the Fed started raising rates in March of 22, I've been mostly have my cash in treasuries because the yields actually got to a decent place. And they're also, I believe they're state tax exempt, and which is good for someone like me in California. So right now I have a lot of my cash tied up in treasuries. I'm rolling it, I kind of laddered it and rolling it on a regular basis, watching that carefully because the rates are changing very quickly. And I'm just waiting. I am just very hunkered on the sidelines right now. Even if we didn't have the stock market correction in the past few days, it would be the exact same conversation we'd be having.
Right. Well, with that said, as well, it is interesting about the Treasury note, and I'm sure you saw this, considering you are probably reading every economic forum possible, that from someone credible, which was Warren Buffett now is the number one holder of Treasury bills. So that was certainly something
Yes.
you were there before, which is risk-free money, right? So when you're doing that and you see him doing that, what does that kind of make you think about? What does that spark any sort of thought in your brain when you see him doing that? Because he's obviously preparing for something to be quite nasty, and he's got information there. He of all people is auditing all sorts of filing books and kind of company roles and whatnot.
Yeah. Well, two things about Warren Buffett. Number one is not just that he now is the number one holder of Treasury of U.S. Treasuries beyond the U.S. government, but number two is that he sold half of his Apple shares last quarter. And that was one of his like darling holdings for a long time. So he's completely risk off. And the thing about Warren Buffett is his main principle, he's a value investor, right? That's just the way he is. And he wants to be in a value deal where he thinks there's a solid brand that's going to just keep chugging along for years, right? So kind of very simple and straightforward. And so to an extent, I'm the same way. I have to be a value investor just to the extent that I don't invest in heavy value add. So I kind of have a similar philosophy to him. And if you look at his Buffett indicator and stuff, then essentially you'll see that it's not at a record high, but it's certainly at a very high, compared to historical. And so he's sitting on the sidelines for the same reason as I am, I can imagine.
Right. Yeah, I mean, it makes sense as well. And you'd rather have cash ready to go and just put it in the S&P 500 if you think there's going to be some sort of, mass exodus and big drop in the stock market. Well, you don't even have to work that hard. You just throw it into basically market beta returns. And by virtue of doing that in a time like that, you're actually going to get alpha, which is great, obviously. Basically free alpha.
Yes, exactly. And so we'll see what happens.
Yeah. So with that said, on your tax exemption strategy, and we look at the world very similarly, if we can get paid an outsized return for not really having to do much work other than the pre-closing structuring and the relationship harvesting, which is, all in itself a decade-long process to get to the point where the deal is pretty streamlined there. Do you need 150 basis points on the positive leverage pre-tax exemption or post-tax exemption? Or are you looking for it 150 points, 125 points, plus splicing on another whole point on top of that, basically, 225 to 250 basis points of positive leverage at closing?
Yeah, no, I'm okay with it being post-tax exemption, and I'm okay with it being probably a minimum of 125 to 150. I've been in deals that were higher than that, but because that's now meeting my criteria where, one of the things I love about that structure is that I like to tell people that you create all that value up front before closing and have reduced risk because of that. The truth is there's execution risk where you have to actually conform to certain state guidelines and requirements to actually conform within the 50% tax abated units and, keep to that. But assuming you have a good operator like you guys, then that piece is kind of, from an investor perspective, kind of a lower risk than a lot of other things, right? In my head anyway. And so, yeah, to me, that's just one of the great things is that I'm getting this positive leverage. How did that happen during a time where everything was negative leverage? And that was just that unique situation. And to your point, that happens as a result of building relationships with local housing authorities, brokers, et cetera.
Right. So switching gears slightly on, the overall market. Of course, I don't even know how long ago. It feels like news and, years feel shorter. And my timestamps of stuff is kind of changing. But Silicon Valley Bank went down not too long ago. And we still aren't technically in a recession yet, which feels interesting to me. It would seem as if you watch that happen and other banks kind of become solvent with it, with Signature Bank amongst a few others and stuff that really had to get bailed out. Are you surprised that it's taken this long for us to be in a recession? Because it feels like we're in one right now. Maybe they haven't announced it yet, but it would feel like that would happen and then the other dominoes will fall, but it just didn't happen that way. So are you kind of surprised in retrospect? And how did they artificially prop everything up to kind of extend and pretend, if you will?
Yeah, good question. So this is actually a really important point. So what I like to tell people, because as you say, I try to be objective, so I just understand where we're going and let the data guide me. So I think what we were talking about earlier here at BC was the fact that if you take a look at how long it takes from the first month that interest rates are increased prior to recession until we actually get the recession, and you extrapolate it out, you would actually, the midpoint of that timing was actually June of 2024. And what that means is that on average, half of the recessions occurred before June of 2024, but half of them occurred after June of 2024. It takes a long time.
From the first rate increase?
From the first rate increase in March of 22. So the reason why I'm telling you this is because a lot of people, like the media, distorted everything and saying last year, oh, there should have been a recession by now. It's taking too long. That's actually factually incorrect. If you just extrapolate and look at history, that's actually incorrect, like just objectively incorrect. So there's been, and this happens, it seems like every time where the media goes through this, actually goes through its own phases. And now we're finally getting to like, oh, there may be the soft landing happens. If you go look at researches on soft landing in 2008, there were a ton of them. There was a ton of mention of it in the media, a very similar amount to today in volume. And so we're now getting to the point where the final stage is like, oh, they're finally admitting a recession may be coming. And that's like, okay, the recession actually comes. So it's actually not taken a long time. It's actually taken so far about average time. And the reason why it hasn't happened yet, in my opinion, and it may be longer than average, is because of all the money printing that occurred. That actually, if you just rewind back, the yield curve, inverted yield curve in 2018 and 19 told us that we should expect a recession in 2020. And in my opinion, had we not had COVID and all the money printing and everything would have just kept going without COVID, then we probably would have had, from a probability perspective, a recession in 2020. That's actually where we are heading. And so then that got pushed back or delayed or kind of propped up, as you mentioned, by all the money printing. There was an inordinate amount of money printing, this whole inflation challenge as a result. That's all gone. All that money is behind us. That's why certain spending and all that. Now this is the first year that a lot of companies, by the way, both in low end and high end companies, are having huge challenges of revenues down year over year because that money's gone. And that is one of the reasons why we're finally going to have this recession, but that's also one of the reasons why it's taken longer than average.
Right, that makes sense. So with that said, are other banks going to come? What do you think falls first from the data that you're saying, stock market, then other alternatives? Because the beautiful thing is that in the multifamily space, in the real estate space, which is very interest rate sensitive, we could be at maybe arguably the cap rate high right now. We could be at, close to the market bottom because everyone has felt the effects of, rates changing. People can make deal size up. There's a liquidity issues for some deals that are, below or at kind of the loan amount, below paper, if you will. So
right.
Do you kind of perceive that all?
Yeah, those are some good questions and obviously complicated topics. The first thing I'll say, which I think a lot of people I've seen a lot of people, especially on LinkedIn on certain threads, posting that, there's been a few very large Class A portfolios, like to the BlackRocks of the world, trading, and that kind of signifies that we're at a bottom. I completely disagree with that. Like I talked about before, the bottom comes when we get a proper reset from a recession. That hasn't happened yet. We get the bottom from fear and lack of liquidity. That's how that happens. That hasn't happened yet. Probabilities tell us that will happen. And so most likely. And so it may not happen, but most likely it will. And so I don't believe that we're at the bottom yet. And I think that's an important point to understand because that's basically what the data has told me. So again, we may be at the bottom, but I'm going with the probabilities more than anything. It's what I have to do as an investor. So I think there is that one more leg down that we have yet to see, and I think that's going to change everything fundamentally.
Interesting. So with that said, what are you keeping your eyes on around the horizon? What are you tracking day in and day out that, that you want to place your capital with what you're seeing today? I mean, have you thought this out, or is it all just opportunistic, whatever kind of, becomes the best value play as Buffett would do, as you mentioned before? Would that make sense to you? Or do you have just certain items that well, like multifamily or debt notes, things of that nature that you'll probably park your dollars in?
Yeah. So on the real estate side, there's two things I'm going to be considering. So first is, there's 1,000 ways to invest. None of them are wrong, but whatever the best fit is for the person. But what I do is maybe 80 to 100% occupied, stabilized property that may or may not have any value at upside. That's optional. I look for predictable cash flow because I live off the cash flow. And so with that in mind, I think the top three asset classes for myself for the next 10 years for predictability are mobile home parks, apartments, and self-storage. And that, with the asterisk that it's all location dependent, will I invest in a apartment building that was built in 1930? No. Like, I have criteria for each of those asset classes, right? Locations, other things. But those are the ones that I see that being the most predictable compared to other asset classes, in my opinion. And so that's kind of what my target will be on the syndication side, as what I call like my A tier assets. I'll also consider B tier assets, but that'll be my favorites. And then the other thing I'm going to do is I'm going to take a look at some REITs, publicly traded REITs within those categories, and see, depending on how much they tend to come down. So assuming we have a stock market correction or crash, usually the REITs end up dragged down just because they're part of the stock market. It doesn't mean that their fundamentals are different. It doesn't mean that the real estate values are different, but that's just the way the stock market works. But what that does is it breeds opportunity, because if a mobile home park giant is yielding 5% right now, but because their stock's down 40%, now it's 7%. Well, should I lock in my 7? It's not a bad idea. It's the exact same thing you said about getting into the stock market low. It's the exact same idea, but this is with yield, right? So I might be able to get close to matching kind of more illiquid private markets with public markets with audited financials and other things, right? With kind of Class A properties you wouldn't normally be able to do. That's a once in a cycle opportunity. So I'm going to be looking at that very closely as well. I'll be looking at both of those.
Very cool. So that's where you want to be in real estate. Is there any other kind of form of investing that's maybe different that you are also looking at that might be a little bit more unique?
Yeah, I mean, I'm always looking at other things as well. Those are more opportunistic. I'm not targeting anything specific once the cycle resets on the non-real estate side. Most of my focus is on real estate. But suffice it to say that once we have a reset, everything will be easier, right? Because prices will be lower. I mean, all the way to the point at which, you know, startups are a little bit different. I do a tiny amount of them, but valuations have reset in the past couple of years. Will they be even lower? Possibly temporarily because of the lack of ability to raise money. And that could be the same across everything. Will multiples to buy a business be lower? For sure, because liquidity be lower. It's the same principle across everything. So my main focus is going to be hard assets like real estate, but I'll look at other stuff opportunistically as well.
Fair enough. Is there a reason why those three assets, self-storage, mobile homes, and multifamily, are calling to you as opposed to anything else? Is that just where your experience lies? What's kind of the genesis of that?
No, that's all about predictability, in my opinion. So when I think about, okay, if I invest in a mobile home park today, where's that going to be in 10 years, right? Am I still going to be cash flowing? There's still going to be demand. And the answer is, in my opinion, in the vast majority of cases, yes, especially when you consider where most of them are located and the needs that they fill. And the fact that, unfortunately, with money printing and inflation that's expected in the future, the wealth gap is going to become bigger and the need for lower cost housing is going to become even higher and higher, unfortunately. And so when I think about 10 years from now, because I invest typically with a 10-year fixed rate loan as a preference, I could see mobile home parks still being in great demand then, and not much probably going to change. I could be wrong, but that's my opinion today. Same thing with multifamily, same thing with self-storage. Now, if you ask me how much in demand is an office building going to be in 10 years, couldn't tell you. If you say to me, what about retail shopping and retail online shopping, retail strip centers, what's that going to look like in 10 years? I'm not sure, honestly.
Well, it goes back to luxury versus necessity. So when I hear what you're talking about right there, the easiest and cheapest one to replicate would be self-storage, if I'm just thinking logically, because if I'm not mistaken, with mobile homes, there's a lot of NIMBYism, which is not in my backyard.
Yes.
So therefore, it's a moat on the supply there. Multifamily, depending on where you locate and buy the deal, if you're doing exemptions, there's a bit of a moat on that as well. So is that kind of into the equation?
Yeah, exactly. That's some of it for sure. But it's also a question of, like, because I'm getting locked in for so long and I have to invest in something I believe will still be in great demand in 10 years. Like, where's that predictability of what the demand is going to be for that type of asset in 10 years? So I'll give you a really good example of what I'm talking about. So a lot of people like industrial. There's been a shift to buying online. And that became very clear in the early 2010s decade, very, very clear. It was starting then. Take a look at Amazon, and can you imagine the amount of warehouse space that they've occupied in the past decade, and how much more? Walmart, same thing, right? So there's a tremendous demand for it. The problem is that Amazon, for example, at one point was experimenting. I was living in Los Angeles. They were experimenting with Amazon Prime Now, which most people haven't heard of, that in very select cities, you can go on and with 1 or 2 hours, get a product delivered at any hour. So if I woke up sick at midnight and my pharmacy is closed and I need Tylenol, I can go onto Prime Now, order Tylenol, and within an hour it would be to me. And it would have the essentials in a local warehouse of a certain size.
The last mile kind of premise?
Yeah. Well, it's not just the last mile, but they actually have to house it very close to you to get it to you within that hour, right? Because they're using local distribution centers to get you that product the next day. But that's different than getting it to you in an hour or two, right? And so it was very unclear to me, where are those warehouses going to be in 10 years? Are they going to start spreading them out locally? Are they not? So I can't even answer that in 10 years from now, right? Because I don't know how the retail landscape is going to shift or not shift. So it's that type of lack of predictability of demand for that type of asset that has me more concerned, and not knowing where that's going to be in 10 years is what keeps it out of my tier 8 list.
I see. That makes sense. So speaking of office, I mean, are you kind of looking at that like, hey, we just don't know, so anywhere there's uncertainty, it's not worth your risk of capital, is kind of how you're seeing that?
Yeah, I mean, look, it's funny because I've seen a few buildings and some syndications buying like downtown San Francisco for 20 cents on the dollar, right? 80% discount. And I was talking to somebody who I know is a very big investor, and he was hesitant to do it. And I said, Well, don't you agree that in 5 years from now, we're going to be looking back and saying, how did I not invest in that building at 80% off? Like, because that's always the way it ends up working. The problem I have is I look for predictable cash flow. And so in the meantime, for that 5 years, like I don't invest in land and wait 5 years for it to appreciate. It's a kind of a similar thing, or, without understanding the business plan and having that predictability. So the lack of predictability for me is the killer. But I do think someone who's doing that deal may do a better total overall return than me, because they're taking that risk and they're going to get that reward. And I think it's a good risk reward at the moment.
It's
So
kind of like if you're a listener and now watching, it's the range is here. The floor, or it's like a ceiling, right? The floor is very low. The ceiling can be very high, but you want to be here, higher floor, maybe lower ceiling. Obviously, you want a higher ceiling, but to eliminate and raise your floor with like an exemption deal or, a treasury bill, you at least are getting some sort of return that makes a lot more sense. That's a little more predictable.
yes, so I go back to what's always served me very well is staying within my box. It's also what Warren Buffett does, right? That's why he's got all this money on the side, right? So you define your box as narrowly as you can, that is in your comfort zone, and you stay at it. And then if you just hell bent staying at it, then sometimes it's very frustrating. It takes years to watch the market change. A great example is I watched so many floating rate bridge loan deals being done. I mean, if I wanted to invest in anything in 2020, 21, and 22, literally 90% of everything I got across all asset classes on my inbox was floating rate bridge loan apartment deal. So I was almost not able to invest in anything because that's all I had to choose from. And yet I just knew it was not in my box. It was also end of cycle, the wrong timing to do that. And so I just sat around, and I think most people don't have the patience to do that. But in this space, if you want to avoid the landmines, you got to do that. Like in 2005 to 8, I completely stayed away from single family, kept telling people there was going to be a crash. People thought I was crazy for a couple of years, and it was very frustrating. It's a long wait. I just went through it now again. And so, but my point in saying all this to everybody out there is, try to build your box, understand what you're most comfortable with. You may be the person that's comfortable with doing a development, and that is going to work for you. And you're probably going to do better than me in total return, but I wouldn't sleep well doing that because not my personality fit. So it's got to fit your personality. And for people who are willing to take risks, there's probably some great deals right now.
Right. Well, that's very interesting. You mentioned all of that there, housing market parallels, because I too, from my residential acumen, I'm looking around like, because I just sold my house, bought another house, and I feel very confident in it because, I know the market very well. There's very good demographics and kind of just overall fundamentals flowing into Arizona. The also interesting about, housing market, of course, if there's a nasty recession, pricing will be affected. But the difference in that market is how many people have sub 4% interest rates and can't afford to leave. And if they have to leave, they'll just turn their house into a rental and rent elsewhere because, hey, they've got equity locked up, so on and so forth. So that kind of creates a stability sector around homes.
Yes.
Well,
Yes.
the inverse and what happened, unfortunately, in multifamily is, or single family in 2000, call it 10 to 12, roughly, where prices really evaluated or plummeted, is what's happening into multi in many respects, where so many people have these variable rate loans or short-term loans where, of course, they're not worth what they used to be, and now the market is digesting that.
Yeah. And so you had mentioned Arbor Realty, I think, earlier, and I sort of, so
yes,
for those of you,
yeah.
So for those of you who are not familiar, Arbor Realty is a publicly traded company. They, I think, were the highest originator, or one of the top three for sure, of the floating rate bridge loans to the multifamily buyers. So I went and shorted, I bought puts on Arbor Realty early this year, thinking, okay, that's going to all implode like within the next year. But what's very interesting, because I've been watching Arbor very carefully. So I actually, just so you know, I actually sold out my position at break even. I'm going to go back in. But because I bought puts, it was time sensitive. So they decay over time, they become worth less. So I couldn't just sit around. I got the timing wrong. I was early. But what's Arbor has been doing is they've been extending loans. They've been doing all these tricks. It's crazy what they've been doing, actually. I'll give you an idea, an example. They have a $12 billion loan portfolio, and they currently have $50 million in reserved losses for loans. Over half of their portfolio is currently either delinquent or on watch, over half. And yet they're allowed to just put in 50 million out of 12 billion for potential losses, which is a fraction of 1%, which makes no sense when almost half of your portfolio is on delinquency or what.
I feel like that's like those guys that are, telling you about the ninja loans and the Big Short, where it was like those two people saying, oh yeah, the worse credit, the better, blah, 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 where it's like, wait, you're only marking it there, or the guy that's eating sushi. And it was like basically not cooking the books, but if that's what they're allowed to report, then that's what they're allowed to report.
That's
right?
right. So they're allowed to do it, it seems. And now they're under an SEC investigation because of all this. I don't know how that's going to turn out. But the point is, what I've learned is that they are able to extend these loans and pretend and do all kinds of these tricks to just keep the ball rolling for themselves for quite a long time. So I'm hoping to jump back in maybe at the end of this year, early next year on another 2 year. I was a 2 year out bet essentially that I made before. So
So
then
you
reset the clock.
so you broke even on that then. So you didn't lose,
Yes.
you didn't make money, which is,
Right.
but then you're going to put another option in for that and another short position coming up. It's you said.
Yeah, I'm going to buy another put, which is a form of a short, and it's essentially I buy him 2 years out because so that's a lower return, less risk, even though it's risky to begin with, and that gives me some time, about a year and a half to be right, roughly. And I'm probably going to restart. I'm going to watch it carefully, and I may miss the boat because if the SEC finds a problem, it may be before then, and I just missed the boat. But I wasn't comfortable holding on now because I've now witnessed them for many quarters, like doing all these shenanigans, and this can go on for a while. And by the way, a lot of it is legal, and so but also what it tells me, which is an important part of this, is that in my opinion now, I don't think you're going to see that much carnage in the second half of this year because of the fact that they've extended so many loans. And I think probably their other lenders similar to them are doing the same thing. I do think at some point they're going to hit ahead. And I'm thinking now that perhaps next year, we're going to see a lot of that hit ahead where they're going to have no choice but to take some of it back. I can go into more detail about what they've done, but in most cases, they've extended loans. They've said, you're going to pay this fee to extend the loan, but since you have no cash and you can't raise cash, we're going to take that fee, add it to the loan balance at the end. And that's it. And they just extend it. In some cases, they actually reduce the rate to make it a little bit more manageable. But the debt coverage ratio for most of these properties at the moment, the average debt coverage ratio, I mean, it's literally in the 0.4 to 0.6 range at the moment.
And just for perspective for everyone, when you invest in deals, and if you're doing agency debt, and Arbor does not do agency, if I'm mistaken, it's just bridge and short term.
No,
right?
they do. They
Okay.
also originate agency, but it was a tiny piece of their portfolio.
They're mostly a bridge provider. If you think of Arbor, that's what you're thinking about is a bridge product. And if you're taking out agency deals, like what we've been purchasing in and using from a debt structure, you need a 1.25 DSCR, which is debt coverage servicing ratio. And
Yep.
short terms, that 1.25 buffer, meaning is for every dollar of debt that you have, you need to have $1.25 of cash flow come in. So basically a quarter spread above the debt dollar coming in to cover your margin there. So that's what DSCR means. It's one of the most pure fundamentals when you're looking at, and I would say investing in a multifamily deal, 3 components I would look at: DSCR, going in cap rate, and yield on cost.
Yeah, and I would say that, so like I was saying before, Arbor's current book is showing to be roughly, like if you analyze it all, is roughly in the 0.4 to 0.6 range for the average bridge loan. And so, and maybe it's closer to 0.6, but the point is that literally half of the minimum required coverage ratio for the agency loans. And that is just a recipe for disaster. Because think about it, if you're below 1, you literally have not enough cash flow to cover the loan servicing for your own property. That's not sustainable. These are all based off value add plays that are supposedly going to increase value over time. And currently, rents are pretty much flat. In some places are down, in some places are slightly up. But this is not the market to be adding value in at all.
Yeah, well, and we're big believers in that as well. And not only to mention, you can't value add the value add. Well, what do I mean? Well, if you're the sponsor, okay, let's just say if you're a buyer right now looking at multifamily, and you're looking to buy a place for 20 million. Well, if the buyer before a couple of years ago bought it for 10 and is selling it for 20, how do you expect to go from 20 to 40? There's just a ceiling to affordability and pushing up the value of a property that can only be done in a time frame. But that's what a lot of people were doing. And that's why people needed to push up and use bridge loans in order to acquire these deals, do these riskier strategies. Often as well with bridge loans, you can take out way more leverage as well to make it pencil and make sense. So there's a laundry list of issues there that are going on these deals that are really going to be impossible to work out. Only way it will work out is time, but time is more of a longer tarmac. This could be a 6-year kind of workout period. The issue is a lot of these deals are 2-3 years or 2 + 1 + 1. So you don't have enough time or leeway there unless you're a massive borrower and you're kind of too big to fail.
Yeah, and unfortunately, what's about to happen is if we do have the recession that seems probable, that's just going to make things worse for anybody who owns these apartments at the moment that are trying to get through these bridge loans and increase value. So it's unfortunately the exact wrong time to be trying to increase value.
Right.
Yeah.
So with that said, I guess just because this is really more of a multifamily show, I'll wrap you up because I know you got to get out of here soon. Thank you so much for coming on the show. We hope to have you again sometime soon. Uh, but with that said, what does the next, I guess, 12 to 24-month time horizon look like to you for the macro level in investing in the market, and then also specifically for multifamily?
Yeah. So on the macro level, I'm expecting a recession. I'm expecting the stock market to go down. The stock market normally is down, for 9 to 18 months, depending on the recession. So it could be relatively quick, could go on for a while. I'm expecting that second leg to come down as a result of the lack of liquidity on the real estate side. And therefore, I'm expecting, rents to come down, vacancies to go up to typical recession playbook. I'm expecting prices to reset further, which I think will breed opportunity. That's for someone like me who's looking for more of a stabilized deal. Someone who's being more opportunistic and is willing to take on a foreclosure, et cetera. Those have already started in low volume and probably continue to increase in volume in the next 12 months and thereafter. So there'll be good opportunity there. But I think an important thing to keep in mind is that the stock market moves very quickly and real estate moves very slowly. And so I'd rather be a little too late than too early on the real estate side. And I think that's very important to keep in mind. That's also why I think that anyone thinks who has the opinion that we're already at the bottom is not taking into account how slowly this all moves. Because it's just not the way it would normally happen. I think there's going to be tremendous opportunity for people who have the patience and wait. And that's just going to be from a typical end of cycle, recession reset. So it's going to be very interesting times between the election and all this other stuff happening. And by the way, we didn't even talk about interest rates, but I do think there will be the first cuts in September. We'll have to see what happens.
Right. So, final question: what would you steer clear from right now? Because there's many options of what to do, but let's just start and kind of
Yeah.
reverse engineer it. What would you not do for the next 6 to 12 months?
Yeah, I would certainly not do anything that has a very short runway, to your point before, because I think we're about to hit a wall on the runway with the recession. So that's number one. And that includes very short-term loans, one-year loans, all those things that where, you demand perfection in a short period of time, right? Or the business plan doesn't work. So it's interesting. There's one school of thought that, there's nothing wrong with investing in a multifamily deal today, because if you're expecting X amount of cash flow and there's a recession, maybe you'll get a little less cash flow. But if you're in the right market with the right operator, you still have a lot of demand. You'll get some cash flow and you'll pay off the loan that's fully amortized or pay down the loan. And then, if it's a 10-year loan, in 10 years from now, you're going to be fine. And that person is probably going to do better than me, because I'm sitting on the sidelines because I'm not earning cash flow. I'm earning money in a treasury that's technically probably going to be a little lower than what's going to happen between cash flow and mortgage pay down, right? So there's that school of thought. There's nothing necessarily wrong knowing you're going into a recession, as long as your eyes are wide open, your expectations are right, and you're investing in the right place and making a bet on the right people. Personally, I prefer to wait and optimize how I'm buying in and just reduce my risk, but I get less reward for that, reducing that risk. So I wait and I end up with less risk, but less reward. So that's the path that I'm choosing. So I'm just sitting tight, waiting to see what happens. And I think treasuries are a good option right now. I think that the rates are going to come down over time, and I think treasuries become less and less attractive. And then everyone's got to make their own decision as to what point it doesn't make sense to have the treasuries anymore and have your money locked up in that. But I'm still definitely rolling into more of those at the moment while I'm waiting. So
Excellent. Well, Jeremy, I don't want to take you forever. I feel like this conversation could go on for 2 more hours, but for coming on, thank you so much. Do you want people to reach out to you? We don't have to allow that
yeah,
from there.
yeah,
Okay.
no, absolutely. If there's any way I can help anybody, you're welcome to reach out to me. My email is jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. Absolutely. People are welcome to reach out to me. Happy to help.
Awesome. Well, thank you so much for coming on. Jeremy is a friend to Lone Star, a mentor to Rob and I of sorts, with kind of his acumen and expertise. So thank you so much for sharing so many valuable nuggets on this show. For all the listeners being here this week, we appreciate it, and we'll see you next week. Peace.